Now let's work through a comprehensive example to reinforce what we've learned about adjusting journal entries. To illustrate the process of making adjusting journal entries from a trial balance and then preparing an adjusted trial balance, the Circle Films example from Chapter 3 is going to be continued in this example. So as a result, the transactions entered into by Circle Films during its first months of operation, the following unadjusted trial balance was prepared at May 31st. So notice again that the trial balance does balance. The debits equal the credits. So on May 31st, Circle Films filmed the retirement reception for the customer who paid $2,000 on May 10th. Circle Films has now filmed the retirement reception, so it no longer has a liability to that customer. It has a revenue instead. However, the trial balance still shows the $2,000 liability. That's called unearned revenue. So the adjusting entry adjusts the liability down to 0 and the revenue up to $7,000. So adjusting journal entry number 1 is a deferred revenue. And that's important for you to be able to look at these and identify, is it deferred or is it accrued, and is it a revenue or is it an expense? Now on May 31st, Circle Films filmed the first night of a 2-night local play. The second night will be filmed on June 1st, at which time Circle Films will bill the customer. The customer has agreed to pay Circle Films $1,500 for each night. The trial balance does not reflect this because Circle Films has not issued a bill. So the adjusting journal entry adjusts receivables and revenues up. So adjusting journal entry number 2 is an accrued revenue. So we're increasing accounts receivable by $1,500 and increasing service revenue. Circle Films has $650 in supplies on hand. However, the trial balance shows $1,000 in the supplies account, which is the amount that Circle Films originally purchased. Therefore, Circle Films must have used $350 worth of supplies. That's $1,000 minus $650. This adjustment is a deferred expense and must adjust the supplies account down from $1,000 to $650 and then record the $350 in supplies expense. Circle Films must pay interest on that promissory note at a 6% annual rate. Therefore, after 1 month, Circle Films has incurred $45 of interest expense because the promissory note, if you recall, was for $9,000, and if we multiply that by 6%, we get $540. Is that right? 9,000. Can't do this stuff in my head. Times 6% is $540, and then if we divide that by 12, we'll get $45. So this is 1 month of interest expense is $45. This expense and the related obligation are not reflected in the trial balance because they have not yet been recorded. Therefore, adjusting entry number 4 is an accrued expense which decreases equity and increases liabilities. Circle Films estimates that depreciation for May on its 2 cameras totals $600. This deferred expense adjustment debits expenses and credits a contra asset account. So accumulated depreciation is a contra asset account. So contra kind of meaning to go against. So depreciation goes against your fixed assets to reduce their value. Once all revenues and expenses are recorded and an adjusted trial balance is prepared, financial statements can be generated. The income statement should be prepared first. So here's our May 31st income statement. With net income calculated, that was $5,255 on the income statement, Circle Film's statement of retained earnings can be prepared next. Recall that the statement of retained earnings takes the beginning balance in retained earnings, which is actually zero because Circle Films is just getting started, adds net income, the $5,255, and subtracts dividends, which was $1,500, and that yields the current balance in retained earnings, which is $3,755. So Circle Film's May 31st adjusted trial balance shows no balance in beginning retained earnings and a $1,500 balance in dividends. Therefore, Circle Film's statement of retained earnings for the month of May would appear as provided on this slide. Finally, with retained earnings calculated, Circle Film's balance sheet can be prepared because we're going to carry over that retained earnings of $3,755 to the balance sheet.